I'm sure you are aware that using a lot of analysis also help you blow the account, because you want the market to respect your trend lines, you want the market to respect your zones, you want the market to follow your levels and everything. So this strategy help you trade what you see, not what you think. So let's say, for example, you were using higher time frame. Already you can see where you could have located your order blocks, but this is what I'll do now. I'll switch. Okay, actually, let me show you different types of market structures. What happened from here to here is trending. When I say trending, it doesn't mean that you must do this, locate trend lines and see if it's touching all your two lines. No, doesn't mean that. I've already explained that trading markets means different things. It means channels, it means a series of same candlestick moving in one direction, which we can also say it's an impulsive movement. And then let me just quickly show you how choppy market looks like. Choppy markets looks like this. So we cannot use this strategy when the market is choppy like this. But if this is H1, obviously if you go to a lower time frame like M5 and then check what happened on this long size candlestick, you will see that the strategy was applying. So check choppy markets on lower time frame like M5 ne? So let me do this, show you choppy markets. This is an example of choppy markets. We can't really do much on choppy markets. Also, sorry, this is an example of choppy markets. You can't really do much. So where there's choppy markets, we see a lot of reversal candlestick, we see a lot of rejections. Sometimes you even see funny candlestick patterns. Sometimes you see price jumping up and down with gaps. Sometimes you just see gaps in the middle of sessions, right? In the middle of the sessions. So and then I also forgot, we have 3 different types of session. We've got London, Asian, and New York. So if you have noticed, when the market opens, in most cases it doesn't really create impulsive movement. Sometimes it opens and then start to consolidate. That's where you locate your order blocks. And then during the European session, that's when you see most breakouts happening. And then during the New York session, that's when you see a lot of continuation. So choppy markets, this is choppy markets. And then ranging markets is when the market is just moving between two horizontal boundaries, which is the level of support and the level of resistance. And you normally see ranging markets after a strong trend. You normally see ranging markets after a strong trend. So I'll just show you one example of how ranging markets looks like. So after a buy movement, ranging markets appears as a double top, and then after a downward movement, ranging market appears as a double bottom. So I'll just quickly show you. This is that I'm not getting a proper example. Not really getting a proper example. But because we're not doing ranging markets now, I'll show you if I get another example. So let's do the strategy now. Okay, this is on gold. We are on M5. So what's gonna happen is that, okay, let me just check a proper example where we can use the strategy. So whenever the market is starting to be choppy, you don't have to panic. Just be excited because it's creating opportunities for you. So for example, up here we had a series of same candlestick moving in one direction. We had 3 white soldiers. So this was an example. So we can use this as an example. And then yes, the market fell big time. So where the market starts becoming choppy, where the market creates small candlestick in one place, this is what you do. So when I draw this order block, I hardly cover the wicks, the tails, because it becomes too big. I just make sure that it covers the openings. and me and you cannot have the same order block. Some people do like this, some people will leave it here, so it depends on how you located yours. You just do this. So let me do this quickly. Yeah, so this is what I normally do. I draw my order block and then extend it to the right before it even breaks. So it means that right now I've got my level of resistance over there. I've got my level of support over here. So right now, I don't know where the market is going to break. The only thing I'm waiting is to wait for a full bodied candlestick to break outside the order block and then start executing my trades. So let's check here. This obviously was going to be our entry because this candlestick, because it broke outside the order block, it broke outside the support level, right? So meaning that we could have waited. So check the second candlestick. It didn't favor what we want, obviously, because we're going on a downward movement. Second candlestick, within that 3 minutes that I was explaining, you could see that with the remaining 2 minutes the candlestick is going to close as a bullish candlestick. So you wait the second one, wait for another 2 minutes. Before it closes the 5 minutes candlestick, within that 3 minutes you can confirm that it's going to close as a bearish candlestick, and then you execute your trade, and then you open your trade over there. So now we want to put a tighter stop loss. A tighter stop loss doesn't come exactly on the outline of the opposite. So it means that our stop loss is going to be few pips. It's going to be few pips outside outside this line, which is the resistance, which is 1836. So based on how much you have, you can just place the stop loss few pips, maybe somewhere here. I'm just calculating somewhere here, but it shouldn't be on the outline. So stop loss depends on how much you put, because I can give out a signal and then put a stop loss here, but if it hits on you, it can blow you, right? So why do I say I extend this order block? This is the reason. Check here. I could have drawn, let me delete this. I could have drawn this order block to this point, because obviously I don't know what's gonna happen next, or up until this point I don't know what's gonna happen next. So the moment I see it's like this is what I do, just extend it. So if we're doing supply and demand zone, this could be our supply zone because the market is selling. So I want to show you why I did this. See, I've extended this to the right. So what I was explaining is that market can come back and test your order block and then exit the order block again. So whenever the market comes back, so if the market is coming back again and then it's giving you three white soldiers, like long size candlestick, obviously this is like chop, right? So if the market come back and test your order block and it breaks the second line, it simply means that market has changed the direction. But you can tell here that the market came back here. So the moment the market enter your order block, you don't do anything, wait for its exit. So we'll wait if it's gonna exit on top. If it exit on top, we do the same thing, we look out for buys. If it exit below, we do the right thing, the same thing, and then we enter our sell signals. So here we're gonna have another entry because it broke outside the order block, and then same thing, same thing. So the reason why I said it always favors scalpers, because we use lower time frame, and people who usually use lower time frame, they don't really stay in the market for so long. So check what is happening today. So this can also confirm. So what is above here, like what is here, outside the order block, it simply means that these were false confirmations. I mean, these were like false breakouts, because the market came back again and then it aggressively broke on the lower side again. So obviously we could still be looking for more sales opportunities. But if you're avoiding that, you can still delete this, focus on the current markets, draw your order block somewhere there, draw your order block somewhere here, wait for it to exit, and then you can tell that it broke on the lower side. So what you'll do is to extend. What you'll do is to extend. This is what you'll do. Is to extend, and then it is seen that it broke on the lower side. So see, the strategy works best when you do this. And then now you can tell that it's creating another consolidation markets. So what I can do here is that I can do this and then extend, then wait for a breakout. So this is like a long-term sell. So what I will normally do here is to look. It broke on the lower side. So what I will normally do, so unfortunately sometimes the reason I said when it comes to order blocks, wait for a full body candlestick, is because sometimes it can do like this. You can see it's breaking with a stronger momentum. So it simply means that it might create another phase of consolidation because it broke with a strong momentum. So if you want to risk it, because you can tell that it broke on the lower side, it broke the support level, you can enter a buy before a full body candlestick closes outside the order block, but that's a little bit risky. So for me, to be safe, I'll rather wait and then execute on the second candlestick, because what can happen is that you can create a false breakout and reverse it and leave a lower wick, and then it turns out to be a buy, like what it's doing now. So those were example of sells. Let's try to locate example of buys. Let's try to locate buy opportunities. Buy opportunities. So let's switch, maybe use Nasdaq, because Nasdaq always buys. Oh, it's dropping as well. I wonder. Okay. Yeah, for example, down here, Nasdaq was choppy. So it doesn't matter if your order block can be huge like this. As much as the market is choppy, you can locate your order block. So you have to locate your order block, extend it. You locate your order block and then extend it, because you don't know what might happen in the future. So you can tell that this here was our breakout candlestick, right? So meaning that since this is our breakout candlestick, the second candlestick opened as a bearish, and it also closed as a bearish. So before that 5 minutes candlestick close, you already know that it's going to close as a bearish candlestick. So you have to wait. So wait for the market to go back up until it opened. It closes as bearish within those 3 minutes that I showed you before. So you can tell it broke out, and the way it broke out, it didn't broke up with a strong momentum. It broke with a slower momentum. So it came test the resistance level, and then that's when it started exiting the resistance level. So you can check, and then give us another consolidation. So the reason I always say extend is because it can end here like this, It can end here like this, but you don't know what is going to happen here. So always extend this thing to the right. And then that's when you see proper breakouts. So here it exited the resistance level somewhere here. let me just locate with an E. It closed above, outside the resistance level here, outside the order block here, and then the next one close as bearish. It means that we wait up until it breaks again and then close with it closed outside the order block, and then here it is, obviously it has to close as bullish if it's outside this order block. So here it closed, so your next entry could be this one. This could be your next entry, and then you enter. Fine. So where do you locate your stop loss level? Obviously you locate the stop loss level below this support level, because now you enter when it exited the the resistance level. So you don't really put it exactly here, put it few pips, like just a little distance outside here, and then you hold. Even though the market can exit here, go back and test, it doesn't really hit your entry, because sometimes they know where we locate our stop loss, and that's what we call stop hunt. They come hit our stop loss and then it favors our direction. So to avoid that, we must place our stop loss below this second line, which is the support level. So it strongly exited, and then fine. So for us to locate re-entries, that's when I'll be introducing you to inside bars. So this lesson was all about breakout of order blocks. So if we can still see more opportunities of order blocks, we can still locate. But at this example here, market started becoming choppy. But if you're still holding, remember when you're trading Nasdaq, you don't hold for so long. Because anything can happen when it comes to Nasdaq. So like what is happening now here, it dropped. The moment it start consolidating, you locate order block and then you enter again.